Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind those dusty corporate filings. Today we're diving deep into what looks like a pretty standard update, but sometimes the smallest details hide the biggest stories. Alright, so this is an 8K filing. Think of it as a company's way of telling the public about something important that just happened, something that isn't part of their regular scheduled reports like a quarterly or annual filing. In this case, it's a supplement to their proxy statement. Now, why would a company file a supplement? Usually, it's to add or clarify information that shareholders need to know, especially when they're voting on something big. The date here, the 7th of January 2026, is when this report was filed. It's talking about events that happened around January of 2026. The company is Columbus Accession Corp, and the big news here revolves around their upcoming shareholder meeting. They had a definitive proxy statement filed back on the 31st of December 2025 for an extraordinary general meeting of shareholders happening on the 16th of January 2026. The main vote at this meeting is about extending the deadline to complete a business combination. They want to push it out from the 22nd of January 2026 to as late as the 22nd of January 2027 in increments. This is pretty common for SPACs, special purpose acquisition companies, which Columbus Accession Corp appears to be. They need more time to find a company to merge with. Now, this little checkbox here might not seem like much, but it is important. This filing is being used as soliciting material to get shareholders to vote in a certain way, specifically regarding Rule 14, a -12 of the Exchange Act. This rule allows companies to solicit proxies before filing a definitive proxy statement, sometimes for communications that could be seen as marketing those proposals. It is worth noting that Columbus Accession Corp securities are traded on the Nasdaq stock market, LLC. They have units, ordinary shares, and rights, all listed there. This means they are a public company subject to SEC regulations. And here is another key detail. They are an emerging growth company. This status gives them certain regulatory advantages, like being able to delay adopting new accounting standards. They've checked the box indicating they are indeed an emerging growth company. The core of this filing is found in item 8.01, which covers other events. The company is supplementing their proxy statement with information about US federal income tax considerations for shareholders. This is super important, especially for shareholders who might be thinking about redeeming their shares. So, what does this supplement actually say? It is providing extra details on how US federal income taxes might affect shareholders who choose to redeem their shares if the proposed charter amendment to extend the deadline is approved. This is a crucial piece of information for anyone holding these shares. This is where things get a bit technical, but let's break it down. The filing explains the tax treatment for US holders and non-US holders when their shares are redeemed. A US holder is generally an individual who's a US citizen or resident or a US-based entity. A non-US holder is anyone else. When a shareholder's shares are redeemed, the IRS looks at whether it is treated as a sale of those shares or as a distribution. This distinction is critical because it determines how the shareholder is taxed. For a redemption to be treated as a sale, it generally needs to be substantially disproportionate with respect to the holder, result in a complete termination of their interest, or be not essentially equivalent to a dividend. These are tests that look at how much of the company's ownership the shareholder retains after the redemption. If none of these tests are met, it's treated like a dividend, and that can have different tax implications. For us holders, if a redemption is treated as a distribution, it is taxed as a dividend to the extent of the company's earnings. Any excess is considered a return of capital, which reduces the shareholder's cost basis in their shares. If it's taxed as a dividend and the shareholder is not a corporation, it might qualify for lower long-term capital gains tax rates, but only if certain conditions are met, like the shares being readily tradable, and the company not being a passive foreign investment company, or PFIC. If the redemption is treated as a sale, US holders will recognize capital gain or loss. This is the difference between the cash they receive and their original cost basis in the shares. Long-term capital gains are generally taxed at lower rates for individuals. The filing warns that it's unclear if redemption rights might affect the holding period for these capital gains. Now, this is a big one. The filing goes into detail about passive foreign investment company or PFIC rules. A company is considered a PFIC if it meets certain tests related to passive income or assets. The filing states that Columbus Accession Corp believes it likely has been a PFIC since its first taxable year. This is a very important disclosure because being a PFIC can create significant tax complexities for us shareholders. If the company is a PFIC, US holders who didn't make a timely qualified electing fund or QEF election or a similar election like a mark to market election can face very unfavorable tax treatment. Gains from selling PFIC stock can be taxed at higher ordinary income rates, and there can be an additional interest charge on deferred taxes. The report urges shareholders to consult their tax advisors about these PFIC rules and the QF election. For non-US holders, the tax treatment is generally more favorable. If a redemption is treated as a distribution, it's usually not subject to US tax unless it's effectively connected with a US trade or business. If it is treated as a sale, non. US holders typically won't owe us tax unless they're present in the US for a long time during the year of redemption, or the gain is effectively connected to a US business. Finally, the filing discusses information reporting and backup withholding. Basically, if you're a US holder redeeming your shares, you'll likely need to provide your tax identification number to avoid backup withholding. Non-US holders will usually need to certify their foreign status. This is a standard procedure to make sure the IRS gets the right information. Now, let's synthesize this. Columbus Acquisition Corp is a SPAC looking to extend its deadline to find a merger target. This filing is crucial because it lays out the US federal income tax implications for shareholders, especially regarding redemptions. The big red flag here for us holders is the likely PFIC status of the company. This can severely complicate tax reporting and potentially increase tax liabilities if proper elections aren't made. From a corporate finance perspective, SPACs are designed to grow and acquire businesses. The extension of the deadline is a necessary step to achieve that goal. However, the fact that they need such an extension speaks to the challenges of finding the right merger partner in the current market. The PFIC disclosure, while technical, is a significant risk factor for any US investor. It suggests that the company's operations or assets are structured in a way that triggers this classification, which often happens when SPACs hold significant investment assets rather than actively operating a business. The company's direction here is clear. They are actively working to keep their merger runway open. The strengths lie in their efforts to stay compliant and inform shareholders of tax implications. However, a key weakness is the very existence of the PFIC rules applying to their shareholders, which can be a deterrent for us investors and signal a potentially complex operational or investment structure. The opportunities for the company are to successfully find and complete a merger that creates a strong operating entity, thereby moving away from PFIC status. The risks are obvious: failure to merge, shareholder apathy due to tax complexities, or simply not finding a suitable target within the extended timeframe. In conclusion, this filing isn't about massive financial swings or sudden strategic pivots, but rather a critical administrative update with significant tax ramifications for shareholders. For existing shareholders, understanding the PFIC implications and consulting a tax advisor is paramount. For potential investors, this PF status is a major due diligence item. What are your thoughts on this PFI disclosure and its impact on Columbus Acquisition Corp's shareholders? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth corporate dives. And don't forget to join our Discord community, linked in the description, to continue the conversation. Thanks for watching, and I'll see you in the next video.